Hi everybody, Lance from ThetaTraders.com here. This video I'm going to go over the covered strangle strategy on HOOD. Just entered this position, so you could also enter it as well. Going to look at how I took the trade, what I'm willing to do if assigned or losing my shares on covered calls. Get right to it. So for Hood, I bought 23.55, 100 shares of it, and I sold a covered call at 25 for 7 days out. So I'll get a good amount of gains if it goes above 25 here. You get the capital gains from 23.55 up to the 25. And then I also sold a cash secured put at the 22 strike and took in 0.43 premium. So both of these positions get a good amount of premium, $43 here, $35 there. And then if Hood stays in between the 25 strike and the 22 strike, then this covered call will expire worthless, and I keep the full $44 of premium. This cash secured put could expire worthless. I get the full $35 of premium. So we're looking at about $79 for the week. It's a pretty good return off the 23.55 shares that I bought. Now, if it goes above 25, then I'm going to be losing my 100 shares. But again, I don't mind that because I bought at 23.55. If it goes up to 25, I get about $145 gain. Plus, I get to keep the covered call premium. And also, this Hood cash secured put would expire worthless, and I keep the full $35. Now, if Hood goes below the 22 strike, I still get to keep the full covered call premium of the $44. But then for this, I would get assigned 100 more shares at 22. So then I would have 100 shares at 22 and 100 shares at 23.55. So I get to average down a little bit and lower the amount of my costs compared to 100 shares at 23.55. It'll be the average of this and this. You could also look into your cost basis and count the $35 that I took in from the cash secured put and the $44 I took in for the covered call. So here's my strategy that I'm going to be using. I'm going to let them expire each week, so I'm not going to be rolling or closing early. Just let it happen and see what happens. Track the cost basis. Also doing IRIN. If you're in ThetaTraders.com, you'll see exactly what I'm doing with that position as well. I'm willing to take up to 400 shares of Hood. So I'm currently in 100 shares. Did a cash secured put for another 100. I'm willing to do another 200 shares if needed. And then if the cash secured put gets exercised, I'm going to re-enter 100 shares and do the exact same thing. Sell the covered call, sell the, that should be cash secured put here instead of PCS. If the covered call on PCS expires, just re-enter both again the next week. I'll look at the specific strikes at ThetaTraders.com if you're interested. And then if I get to the max number of shares, that means it drops a lot because I'm entering in new cash secured puts every week. I'm going to be selling covered calls and make sure that it's above the cost basis. So then if it does bounce back up, I'll be able to get out at a profit. I do have permission to not sell the covered calls if the premiums are too low. So if Hood drops a lot, let's say it goes down to 20 or 18, the covered calls in my cost basis won't be worth that much. So in that case, I would wait for a recovery on it possibly. And if either stock runs up too much and it's moving really high, I would have done very well on the trade because I'm taking in those covered call premiums, cash secured put premiums, getting some capital gains on the shares. But if I feel it's oversold, if the RSI is very high, if it looks like there's a resistance zone coming up, then I'll look to just stop this strategy. So again, if this was helpful, just let me know in the comments down below. I'll see you guys in the next one.